Hello, everyone. We'll be starting our next track, Embedded Finance, Changing the Innovation Roadmap. Moderating the track will be Danada Ramnishta of Climb. Joining her will be Sankat Pathak of Synapse, Alicia Chen of Climb Credit, Simran Singh of Green Dot, and Loveleen Sidhu of BM Technologies, who won Fintech Nexus's Executive of the Year award yesterday. Thank you.
Thank you. Hi, everyone. Excited to be here with all of you to have this conversation about embedded finance. I can attest, sitting from here, that if we make funny faces, it's the lights. It's not because we're vehemently disagreeing with each other. It is bright lights over here. But I'm thrilled to moderate this panel with very passionate leaders about embedded finance. We've had conversations in preparation for this, so I just can't wait to get it going. But before we get there, if each of you would just introduce your organizations, that would be helpful for everyone.
Thanks, Danada, and looking forward to an engaging discussion with my co-panelists today. My name is Simran Singh. I lead business development for Banking as a Service at Green Dot. Green Dot is one of the largest digital banks and fintechs that serve more than 60 million customers directly and many million more through our partners, including Apple, Amazon, Intuit, etc. I'll pass it on to Loveleen.
Awesome. Happy to be here. I wish I could see more of you, but maybe that's good to calm nerves of the panel. At least we can't see you. My name is Loveleen Sidhu, and I am the founder, CEO, and chair of BM Technologies. And we are one of the largest digital banking platforms and banking as a service providers in the country today. We take a B2B2C approach for customer acquisition, and we really serve two main verticals today: higher education and student banking. And the second segment is really helping non-banks and fintechs and brands launch financial services products. So again, very happy to be here today and excited about the discussion.
And let me take a second here. So Loveleen was named Fintech Executive of the Year last night from Fintech Nexus. So if you'd join me in an applause, congratulations.
Thank you, guys. Thank you.
Hi, everyone. Very excited to be here as well. I'm Alicia Chen. I'm at Climb Credit. Climb partners with educational institutions who are providing alternative career advancing and sort of vocational programs. And we partner with them to provide financing, so loans and also payment solutions for their students.
Hey everyone, I'm Sanket. I'm the founder and CEO of Synapse. Synapse is a US-based banking as a service provider. We bank about like 11 million customers and process about like roughly $80 billion or so every year. This year probably a little more, but yeah.
And I'm Danada Ramnishta, your moderator today. I am the CEO of Climb. I did discuss this with Alicia. We spell Climb right. I don't know what happened with those guys. But we're the all-in-one platform that supports small businesses with tools to enable them to run their business. All right, so let's get to it. So we're in an era where everybody, practically, is positioning themselves as an embedded finance type of company. So before we get to it, let's debunk some of the myths. So Simran, I'm going to start with you. What does it actually mean to be an embedded finance institution?
Well, I think perhaps for the first time in the history, and depending on the response I get today, maybe the last time in the history, somebody's going to explain an embedded finance company by comparing it to the cereal industry. I'm talking the Kellogg's cornflakes. Bear with me, it's going somewhere. So if you think about it, early on, it was the same company, say General Mills, which would manufacture the formula for a cereal, get it FDA approved, then manufacture the cereal itself, package it, handle all the operations. Then came the likes of Trader Joe's and Whole Foods, who said, hey, why don't we get X to manufacture, Y to package it, and Z to handle the operations for us. We are a brand which is trusted, we have the distribution, so we will get this product in the hands of the end users. This, ladies and gentlemen, is the embedded cereal industry. So if I take this analogy over to the financial services space, and you think about a non-financial company, say an Apple, which is looking to provide financial services to their end users, they will use a bunch of companies on the back end to deliver those services to their end users. Now, in my opinion, there are 4 layers to this embedded finance puzzle. You have the licensing layer. So it could be a banking license, money transmission license. Think of this as the FDA approval layer when we're talking about the cereal analogy. Second is the technology layer, the APIs that are used to deliver those products. Think of this as the cereal manufacturing layer. The third layer is the operations layer, risk, compliance, fraud, customer support, everything that is required to support the product that you've built. And then the fourth is the cereal box layer, right? Like the user interface layer. Now you have some companies like Green Dot, which will provide all of these 4 layers in one. But in general, I would say if any of the companies is providing one of those layers to a non-financial service company, I call it an embedded finance company. The challenge, and what we should debate today, is that term, embedded finance, has become so hot that every company wants to be called an embedded finance company. So you're no longer a payment acceptance company, which has been around for decades. Now you're an embedded payments company. So I posit to the panel today, like, is there a clear distinction between what is and what is not an embedded finance company, or is there a spectrum that the embedded finance industry falls on?
Alicia, you want to talk about some of the myths?
I'll give it a try. Yeah, I actually do think there is a spectrum. And kind of relating to the myths question, I think maybe one myth is that the only way to do embedded finance is to do like a full stack integration that's like maybe fully white labeled. And I think at Climb we've learned that the schools we work with have all sorts of different needs, and we really need to meet them where they are. And sometimes, for us, that would be embedding an option to, take financing for somebody's program or a payment option within sort of the checkout flow of the school, and it's great when we can do that. But for other schools, they have a completely different way of operating. And for instance, we work with some truck driving schools where people actually enroll in person and not online. And so trying to build an embedded finance product looks very different for, that sort of a school. And I think it's really important to think about this whole concept as being sort of not a one-size-fits-all solution, and really one that needs to work for whoever the merchant, or I guess the equivalent, is in question. So I guess I would say that's sort of one myth that we can hopefully debunk. And then kind of alongside that only big, really sophisticated organizations are able to adopt embedded finance solutions. I think that's also not true, because there's such a proliferation of providers out there and this kind of range of different solutions that exist, that there probably is something that works that could be, maybe lighter touch and more out of the box. And certainly that doesn't mean that a lot of preparation doesn't have to go into picking a provider and setting up the relationship, but I think that there are solutions that work for, the scope of organizations out there.
Yeah, so there you have it, right? So you can't now split it in your head. When you think of embedded finance, you're going to think about cereal.
Hopefully.
Right, yes. And also this notion that, yes, so there is the embedded solution, but oftentimes the flexibility to provide pieces depending on the needs of the customer. So as now we've sort of set the baseline and understanding of what embedded finance is, Loveleen, would you share with the audience your perspective of the value of embedded finance into the market? What value does it provide? What does it add? And how has it shifted things?
Yeah, I think that it depends on which stakeholder you're looking at. So if you're looking at the actual fintech or the actual brand that wants to institute embedded finance, there's very clear value drivers. Some of them is, number one, is maybe they're already playing in the payment ecosystem like you talked about, but they want to leverage that more, and they want to monetize that more. And they want to be able to do that without building the banking infrastructure or getting into the regulatory business of being a bank and the headaches that come with that. Number two is they want to be able to, as I said, monetize that more, meaning can you enhance customer lifetime value by plugging in more embedded products and services around that transactional relationship that already exists. And in doing so, can you provide so much convenience that you're adding more loyalty, more stickiness, and more, as I said, customer lifetime value. And also, as you're providing more of these services to your customers, are you getting access to more data, which then you can cross-sell or inform yourself to be able to provide even better experiences and better products to your customers, and et cetera. So, you know, and for many, you know, since that payment transaction is already existing within the ecosystem in some way, it's usually a credit card or some other payment vehicle that's creating interchange expense for your company. And so there's huge cost-saving benefits on top of the revenue enhancement opportunities for these businesses that want to get into embedded finance to be able to benefit from. And then from the customer standpoint, that if you're already going to a brand that you love and you have that emotional connection and you're transacting with them often, then there's this idea of accessibility and convenience that comes from an embedded finance option. Now maybe I can go to the Amazon of the world, et cetera, or Walmart or wherever, where I go anyway, and now I can get layered on other financial services and products that maybe I wouldn't have had access to otherwise, or if I did, it sure as hell wasn't convenient, and now I'm here already, so let me get it there. So I hope that's helpful.
Yeah, and Sankeet, what do you have to add to the value of embedded finance to the market?
Yeah, I think if we step back even more and kind of try to figure out what are we trying to do with embedded finance is we're trying to realize a vision of the world where initially the first thing that internet had was knowledge. You used it to search things and learn things. Then communication became a part of it. Then entertainment became a part of it, and so on and so on. So the bigger philosophical question is, does store value in money need to be embedded within the internet protocols? That's essentially what embedded finance is about, right? Do we want to live in a world where store value, credit extension, all the financial instruments you can think of can be just permuted through and just embedded into a platform? A good example of this is you keep a little bit of money in your Starbucks wallet, and then that makes it much more effective and efficient for you to be able to transact with Starbucks at a cheaper cost than it would if you're using a credit card every day. Now, expand that further to all these microeconomies that exist. Fortnite in itself is an economy. Twitch in itself is an economy. TikTok in itself is an economy where people are getting paid for entertainment, people are getting paid for commerce, and people are paying for those things, either by looking at ads or by buying something. So the long-term vision of embedded finance, the real value is, could financial services just become a protocol in the internet and just works for people? Because it seems like there are tons of use cases where it doesn't make a whole lot of sense to have a brick and mortar bank and a card as the only conduit between that bank and the rest of the world. So I think that breaking that barrier is probably the biggest thing. Now, I think anyone, like to Simran's point, these are 4 layers and they're like very well articulated. Like any one company that's trying to attack one of those is probably trying to accelerate the vision of embedded finance. But I don't think any company is an embedded finance company unless they really make that plug and play a reality, which is with few lines of code, a school could just embed a checking account without having to worry about risk, operations, compliance, licensing, etc. So I might be the only embedded finance bigot on the stage, which is I don't think anybody is an embedded finance company unless they meet that threshold. And it's essentially that binary, and everyone's trying to accelerate that reality, but I think you won't be able to permute through all 4 layers unless you are one company permuting through all of them. I think you're not going to have small schools wanting to get a KYC provider and a payment processing provider and a bank service provider and build the operations. Apple's successful because they have a large balance sheet and they could push their weight and get it done with Goldman Sachs, but you won't have that across board. So,
And so what you're saying is that there's clearly been an evolution to the notion of embedded finance, right? Because once upon a time, we talked about this. If you accepted payments in a certain way,
Yeah.
you embedded the finance solution, if you will. And now we're raising the bar, right? So we've
Yeah.
evolved, and innovation has raised the bar on what it actually means.
I think it has to be a higher fidelity experience because that's what customers really want. A portion of that is enablement, which is people have never had access to some financial instruments. If you live in India or if you live in Brazil, historically you have not had a way to be able to hold the most stable currency on the planet, and you've had to deal with all the fluctuations and volatility. The big piece is changing that. I do think the future is probably few stable currencies that get most of the deposits, and people would not, it would be borderless. It won't be like if you live in America, you get USD, if you live in India, you get INR. I think it's going to change. And so first piece is enablement. I think the second piece is convenience, because there's so much happening in the digital world now. It makes almost no sense to call just payment processing or payment enablement embedded finance because it's very clunky and not convenient.
Yeah. So you've got the element of convenience. In many cases, as we're leveraging data across the board, fraud prevention is looking different, right? Anything to add from the regulatory perspective here, Alicia?
Yeah, I mean, I think the regulatory perspective is one we should think about as part of embedded finance for sure, and certainly all the regulations that would apply if it wasn't an embedded finance product still apply in the embedded context, and so and are probably made more complicated in many aspects. So we've talked about licensing and making sure that the entity that's providing that service does have the proper licenses. Whether in our case we're a lender, so we have to have state level lending licenses or bank partnership, and there's an equivalent for every sort of type of embedded finance category. Beyond that, certainly like the data security and privacy concerns are very top of mind since so much information is being passed through different entities. So yeah, those are like a couple of examples, I think, and there's lots more. I think certainly making clear the roles of the different organizations, perhaps not kind of on like the main page, for instance, but you want to make sure that there's somewhere people can look to really understand who is doing what in this relationship, and that's clearly disclosed.
Actually, a few years ago, OCC wrote this third-party risk management booklet, which is like, I think 5 years ago or something like that.
OCC and Berkey?
OCC, like the regulator OCC. So there's
Something perky from the OCC?
Yeah. It's like third-party risk oversight,
Okay.
and how should banks think of it. I think that's probably like the most articulate framework to follow for any embedded finance product in terms of what should a licensed entity be thinking about when they're enabling third parties to be able to provide their products, essentially.
So obviously there's the common theme of acknowledging this investment, innovation in embedded finance, and us as industry raising the bar. Let me just pivot a little bit and ask you, Simran, around how has the banking crisis affected embedded finance from your perspective?
It's a loaded question. I think the hypothesis of embedded finance that we have is that trust, especially when it comes to money matters, is so paramount that it supersedes everything else. And therefore, the financial relationship that you build with a brand that you trust, an Apple, a Google, an Amazon, that will supersede the need for, say, hey, I'm getting 4% at this unknown bank and I'll park my money there. So the banking crisis is actually going to accelerate that move away from these no-name, low trust, traditional financial institutions, more towards the non-financial services which have built a complete circle of trust with their end users, and now have also started offering financial products to that. So I know it's a controversial topic. I'd love the panel's opinion on it as well, but I feel it's good for the embedded finance industry because it's going to accelerate the move for end users their ability, their comfort with an embedded finance product.
So you feel this shift of maybe some distress being created in the traditional ecosystem will cause more leaning into fintech. That is indeed controversial. Yeah.
Very. Yeah, I'll be transparent. I've never seen the industry this much in flux ever since I started Synapse. It's terrible. Like, that's just the honest reality. Banks are afraid to do anything, and large companies who can wait it out are just waiting out. At the core of it, the bigger issue, and I don't even have answers for all these questions, is historically when a bank got into embedded finance or banking as a service, the business model was very straightforward and pretty much copy-paste. It was, we're going to acquire deposits at a low cost, and then we're going to lend it out and just improve our net interest margin. Now, two things have happened. There has been a push for giving higher rates to consumers, which has really completely eliminated the possibility of kind of like getting the low cost of deposits acquired. It turns out in most cases, community banking is giving you lower cost of deposits now than fintech is. The second big thing that SVB has done is the fintech money has now become hot money. What that really means is if you are trying to invest or lend that money out, you cannot anticipate when there might be a bank run. So it's very hard to really do anything with these deposits, which has big contemplations for banks, right? If all fintech deposits become brokered deposits, which essentially are kind of like the hot money, by definition, you cannot invest it, you cannot lend it, you cannot do anything with it outside of parking it with the Fed or maybe in like very short-term treasuries. And I don't even know what that really means from a business model perspective for a bank. So I think there are some things that are in flux. Here's what I do know though. There is still massive demand from a consumer perspective to be able to get access to financial services that they historically have not had, and to be able to get financial services at convenient places where they spend time at. So both of those needs at some point will supersede the flux that's going on. But there's a lot of flux, and I'm not fully convinced that people really kind of like, that flux goes away if Apple or Google end up selling a product. Like, we've gotten pretty close to getting Bernie Sanders into like the main election. By definition, people have all-time low trust in capitalism, all-time low trust in brands. So I don't really know if somehow Google changes that equation. So I don't think that has an effect.
Can I add two things to it? First, around the business model, which I think is very interesting because where did the name banking as a service come from? It came from software as a service and now everything as a service. But if you think about the standard SaaS business model, it is not reliant on revenue that is not predictable. Your net interest margin, your interchange. Look at the European banks. The regulators have capped the interchange at, I think it's 20 basis points versus 200 basis points in the US, and it's coming. It's coming even in the US. Sorry.
It has already happened with large labels. Large labels have negotiated private deals where you can see the effective interchange going down to 0.3%.
That's correct. And I think it's good that, again, this acceleration of a true as-a-service business model is happening, and it's being precipitated by the flux in the industry, et cetera. And the second was, I agree with you that there is very little trust in capitalism, but I will disagree on the fact that there's very little trust in brands. The fact that an ecosystem like, say, an Android or Apple, it has access to my identity, my transportation means, my payment means, basically my whole life, and I have gotten comfortable with that fact, and that it's no. I was at a roundtable with someone from Google Pay yesterday, and they said the mistake that they made was they introduced financial services into the Google ecosystem a bit too quickly before they had chance to establish that trust with the brand. Whereas Apple has taken the more patient approach of step by step, very quickly over 10 years, they've been able to build that trust. So. I agree, capitalism, the trust that you have is at the lowest today, but the trust that you have in some of the more well-established brands, they are trying to find ways to now either monetize that trust or continue using that trust by building more retention engagement with their end users.
That's I mean, talking about interesting perspectives, right? So I actually call it Fintech Nexus team. We need this panel back next year to see how the chips fall on this, right? It's an interesting time.
Yeah, I think
It's
we
an
don't know
interesting
how
time.
some things would land for sure.
Yeah, yeah. So just pivoting a little bit. So now we've talked about the myths of what embedded finance is not, what it is, the value that it provides in the ecosystem, how it's sort of molding around the pressures with the banking crisis. So we've talked about all of that. So as we think about companies and institutions trying to adopt embedded finance, this question is for you, Loveleen. What should they consider? What is part of that equation that's imperative to consider as they're imagining the way of doing business with embedded finance?
You know, like we talked about, many of these companies that we're talking about that fit into this embedded finance sort of definition are already having some sort of transactional relationship with the customer. And if they're going to grow that into more products and more services, I think what do they have to think about is why? You know, what is the value in doing so? How are we going to create more value for the core business? What is the synergy between enhancing more financial products and accessibility there, and what is that going to do that for our core business? When we sit in meetings and we pitch and we learn, those that are successful, Sanket, you probably see this too, in actually launching an embedded finance strategy are ones that are clear about why they're launching it, what is the value to the core, and are they going to get the resources and scale? Because we rely on them to know their customer, how to market to them, how to reach them, because without scale, these programs also don't make money, and it's really a loser for both parties. And so that's one. And then second is, you know, to Sanket and Simran's point, who's going to help me do this as seamlessly as possible? Because it is getting hairier. Now your risk, you know, department is going to look at who's your sponsor bank. How much stability do they have? Do they have good third-party risk oversight? So you have no sort of room to sort of mess up too much here. You want a well-oiled machine that can really bring these layers together, have scale, have proven it multiple times with various different partners that they've worked with, because you don't have the ability to sort of mess up on the risk metric side now.
So the moral of the story here that you're outlining is, one, have clear definition on the need and what you're trying to solve internally, and who best matches in a way that has considered all of the facets that will enable you to deploy it fast, right? Fast in an efficient way. Anything to add?
Yeah, if you guys haven't figured out, I'm an analogies guy, so here comes another one. By a show of hands in the audience, anybody who's gotten a new house constructed over the last 5 to 10 years? I see a few hands raised, but think about it. When you were making the decision of building that new house, you had a few options in front of you. You could have gone with a construction company which has everything in-house, they take care of everything. A second option that is available to you is, let's say you work with a general contractor, that's your only liaison, and on the back end, the general contractor will hire a bunch of subcontractors, et cetera. And for the more adventurous of you, you said, I'm going to go find the best carpenter, best electrician, best plumber, and I will manage it all myself. So again, coming back to the embedded finance space, if you think about the 4 layers that we described, you can have someone like a Green Dot, and I would say BM Technologies as well, who will handle all the 4 layers for you in one go. Or another BaaS provider where they will act as your liaison, but behind the scenes they are working with different parties that are handling the 4 layers, or you can cobble together the solution on your own. And actually, Sanket, through the conversation today, I came up with a 4th option, which I hadn't thought of earlier, which is completely thinking outside the realm of the fiat world or the financial services world as it exists today. Maybe use a different protocol or a different way of moving money, of holding deposits, et cetera, which is not being done in the traditional banking as a service company. And again, there's no one right option or another. Of course, me and maybe even Loveleen will say that option number 1 is the best, but you got to figure out what is your strength, what is your skill set, what is your resourcing availability, and then decide which option is best suited for you. I promise that was the last analogy. I'll stop with my analogies now.
Wait, is the time to integration also a close analogy to what the general contractors say versus the reality?
Getting too close to home.
Come on now. Yeah, so, okay, I'm going to pivot now. I'm going to stop with my questions, not because I want to, but because I probably should, and give you an opportunity to ask our panel questions about embedded finance. So I don't know if we have a mic, but I think we can hear each other close enough, so.
Maybe not see, but hear, sure.
Yes, see, I'm not so sure, but yes, here. Anybody have any questions for our panel or comments? Come on, they can take it. They showed you they can take it. No? No? All right, well, yeah, we have, okay, yes.
So before the banking crisis, like with a company like Synapse or another bank as a service, would you take a close look into your bank partner balance sheet and take those things into consideration? And like, how are you thinking about that going forward?
It's probably answered by me. No, so we didn't, right? Like, no one was looking at the loan deposit ratio of a bank and doing a complex analysis. People are still not doing it, and the whole reason for that is that the supply is still less than the demand. So what the banking crisis has done is it has shell-shocked a lot of banks into participating in the space or onboarding new programs, right? So Cross River is a good example of this. It's public announcement with the FDIC. So everyone's afraid of something like that happening with the regulators. So you're seeing a reduction in supply, which essentially makes it harder for people on our side or our customer side to be able to be very selective in which bank partners they work with. I think that can exacerbate the situation, I would say. Like, I'm sure once the pendulum's done swinging on the other side, when we would normalize and, well, the demand has always been higher than the supply in this business, but maybe supply increases a little bit than what it is now, then I think that makes sense, which is you're going to start doing some kind of risk assessment on the bank partner you work with and so on as well. But I think that's more theoretical than operational today.
Just going back to one of the questions that you had and tying it with what you'd asked, one of the myths pre-banking crisis, post-banking crisis was banking as a service means I don't need to worry about compliance and risk. I've had prospects come to us and say, what do you mean you need documentation? If we needed the documentation, we'd just go to a normal bank and open an account. So, the truth is, again, all those 4 layers, the FDA approval, the manufacturer, the boxing, everything needs to be done. It was just being done by different parties. So it didn't mean that just because you're using a different model, you could get away with less compliance. And that's become very, very clear post-banking crisis.
Anyone else? You have to shout out because I really can't see. No? No, we have a quiet audience here. So I will take the next one. So I'm going to ask this for all of you. If we think a year from now, when we get back together, we already made the plan, what are things that we're going to see? Like, what is that momentum building, right, around embedded finance that, we will be talking about in a year's time, maybe a little over that?
You want me to start?
Yeah, please.
I think it's hard to predict in 12 months type time frame. I'll go back to the big picture. The big picture is still very much so the same. More people need access to financial services, and more people need access to financial services in convenient ways to meet them where they are. I am of the opinion, I think the end state of embedded finance is product constructs that are a little bit more simplified than they have been in the last 2 years. So things would simplify a little bit more, which means there would be a little bit more of a tight rail around how you can present a product, what T's and C's it has, how can you market it, going all the way down to what can it actually enable, what can it actually not enable. So I think there's going to be some tightening in 12 months around this. And it's going to shake up one of the two ways. Either the middle layers, which is kind of like the operational layer, is actually the biggest one. People have figured out licensing, people have figured out technology. It's operational efficiency in the ops world. If that layer becomes substantially superior than it is today, then I think the BaaS, the way it works today, will continue to work. I will, like a technical person, like I'm fairly convinced that wouldn't happen. What that really means is, I think there's going to be more verticalization of things where you're going to have no-code solutions out in the market, and maybe one company specializes in lending and one company specializes in white-labeled store value and so on and so on. And I think those products will become a little more predominant because risk underwriting and oversight is much simpler when everything is essentially the same, in quotes, except the logos are changing, versus if things are very bespoke. So I think the bespokeness is going to reduce.
That's great. Any other perspective?
I can just add that, for us, when we go out to the market and do research on what our students who are thinking of taking the programs that our schools offer are considering, they always say the top factor is like cost and financing. And so it just feels to me that, like, given that's the sort of top factor people are using to make decisions, this concept is going to continue to grow, and there's really no way for a school who's a partner of ours to offer a program that doesn't have some sort of financing option. It's really like existential to them being able to offer the courses they offer. And so, yeah, I agree. There's so much influx, and I'm not sure what's going to happen in a year, but I think that, we need to find a way to be able to allow, in my case, these students to finance their school. And so if that means, more embedded finance, I think that makes sense. And I think some of the trends we were talking about around kind of picking partners and sort of the diligence on those partners and the compliance aspect being more and more important, I think we've seen a bit of that, and I think that's also a trend that will continue.
Yeah, I would say, like, if you asked me a year ago, I'd be, double down embedded finance, and we're really at the beginning innings of it. And the reason why is because, as we said before, there's so many use cases in almost every business of how you can sort of expand and, the embedded finance use case. We also have the technology now to do it, and we have consumers and the trend of being able to provide accessible and convenient financial services and access to it. But the reason why there's a pause now is because some of the things that have already been brought up. But, we've really gone after companies that have scale, because unless you have, a large population of customers that we can go after and launch these products to, you don't have the revenue to be able to support the complexity of the operations to run these programs. So players like us have to do banking operations, we do fraud as a managed service, we do compliance as a service. And these programs are difficult to run unless you said, right, there's such verticalization that you're doing one thing and you're doing it over and over and it's repeatable. But complex, to run these programs is very complex, and you need scale. So unless we can figure out how to operationalize these programs better and roll it out in a more verticalized way, et cetera, I think it might be difficult to scale.
I think if you go back to the first principles of embedded finance, the main thing about it was that, hey, you'll have a lower cost of acquisition, access to lower cost of capital, you'll have operational efficiencies, and therefore you can deliver the same product, same service at a lower cost to the end user. And that has not really played out if you take aside the VC-backed
subsidies.
Subsidies is probably the right, I was looking for a more politically correct term, but subsidies is the right term. So I think, again, with the maturity of the ecosystem, and to Lavleen's point, us being almost in the first innings of this industry, you will eventually see that hypothesis play out, and what it does to business models, does it lead to consolidation in the industry? Those will be the topics we'll be discussing in 12 months' time.
Wow, that's exciting. So we have a question from the audience that's written down. So Lavleen, if you don't mind taking this, what is the narrative, you touched on this a little bit, but round it up for us. What is the narrative to a non-fintech executive on why they should prioritize embedded finance versus other projects that they may have on the roadmap?
I think it only makes sense to prioritize it again when you go back to why. Why are you launching it? What is the use case? How is it going to generate either revenue, enhance customer lifetime value, more stickiness, more access to data? And you have to sell that to your core business and attack. The more synergy you create between the financial products that you're launching and the core business that you're running, like today we have T-Mobile, so we're always thinking about how do we make the bank account T-Mobile money easier for the core business of wireless to run its business, attract new customers, engage and retain them. And so I think that those are principal questions that need to be asked.
So as we wrap up, so the summary is, you see, we have some common understanding of what embedded finance is. We clearly see the value. We've discussed here how it's shifted depending on the market pressures and regulatory pressures. Ultimately, the amazing things about embedded finance is that, one, it's enabling more people to have access to financial products. And that's a great thing for communities and the wider world. And two, it's making the lives of those who already engage better because it's enabling that interaction to be much more seamless.
And it's not boring, so.
Yeah, that's right. That's right.
Fine.
So now that you've heard it, we had a question for this panel saying, will embedded finance dominate? What are we thinking?
If you take a long-term perspective, this is a very hard problem that does need to be solved. Internet needs to just be able to embed and program financial services. What's going to happen? Now, which logos are going to do it? I think that's going to be in flux for the next 24 months. The bigger shoe hasn't even dropped around commercial loans and the delinquency rates over there. It's like, we're going to have more stuff going on. But if you take the long-term perspective, like, we're nowhere close to being done. Yeah, there's tons of opportunity.
Well, you heard it here. We're just getting started. So for purposes of time, I do want to thank all of you for being here for this very interactive and fun discussion. And thank you to all of you for being here. So much appreciated. Look forward to next year. I'm already live on this.